Hi there, I'm Dean Orrico, President of Middlefield Capital, and I'm here today to introduce you virtually to one of our core holdings in Middlefield Canadian Income, which is Granite Industrial REIT, and the CEO, Kevan Gorrie. I think as many of you know, we've been focused on industrial real estate within MCT for a number of years, and our largest industrial real estate holding is Granite REIT. Granite has been a long-term holding at Middlefield, and we had a very positive experience with this real estate holding. And Kevan Gorrie as CEO. Kevan joined Granite in 2018, prior to which he was the CEO at Pure Industrial REIT, which was another of our long-term holdings at MCT, which was actually sold to Blackstone in early 2018. We've effectively taken the proceeds from that disposition, that transaction, and have actually invested it in Granite, making Granite our largest industrial real estate holding today. So we're going to be covering the whole industrial real estate sector today with Kevan, including e-commerce. So with that, Kevan, how you doing?
Doing well, thanks. Thanks, Dean.
So I just alluded, Kevan, to e-commerce, and we know that this has been a powerful trend for many years. It's been our view that effectively the pandemic has given e-commerce and online shopping a major shot in the arm, and I think people are questioning how sustainable that is and how important that is to the industrial area. What are your thoughts there in terms of where e-commerce goes, especially over time? I think if we look at this as glass half full, the pandemic will over time here get better. We've seen some vaccine news and some therapeutic news. How's that going to impact online shopping and e-commerce generally?
Yeah, I do have some thoughts there, Dean, to be sure. I mean, when we went into COVID and the various lockdowns in March, I think we were in the same boat as everybody else. Like, we just did not know what was going to happen, how tenants were going to react to this, and how governments ultimately were going to react to it. But then we realized in our sector very early on a couple of things. Essential businesses were allowed to remain open. So one of the things that we noticed kind of across our portfolio is the vast majority of our tenants continue to operate in their space. Like, it's not like a mall. It's not like an office building even, where the landlord has control really over access to the space. Our buildings are mostly single tenant logistics buildings where the tenants run the properties themselves and manage the properties themselves. So they had access and operated out of the facilities through all of COVID, essentially. And that really, I think, for us, sent us a message about how essential supply chain and distribution and e-commerce really are to society. And that really was encouraging for us. Like, we're effectively 100% collected through October. And I don't know any other company that can report that. So we're very fortunate to be in our sector in e-commerce. One of the trends that we saw was maybe for March, April, and a bit of May, there was a real immediate softness in the market because no tenant was willing to make a decision. So leasing did stop for maybe 6 weeks to 8 weeks, but then it picked up very rapidly, led by e-commerce, including Amazon, which were dominant in the absorption in the second quarter and into the third quarter. But also there was this realization that just-in-time distribution was breaking down. So the supply chains were breaking down. People were running out of toilet paper. Everyone remembers that. But that was a cascading effect across the whole industry. And we saw tenants in our portfolio and in the markets rushing to take up space as much as they could because they did not want a repeat of shortages. And so I think that that's something that has legs. So if you have someone that, and we heard it from some of our tenants, particularly the third-party logistics providers in our space that are whose clients are Walmart, Best Buy, and others, they were being asked to carry 5 to 10% higher levels of inventory during this to avoid the sort of shortages that we saw early on in the pandemic. So I think that that has legs. And so that itself, if that's 5%, if they have to carry 5% greater inventory, that translates into roughly 150 to 200 million feet in the US. So it's huge. It has a huge impact on our industry. And certainly this is something we've seen in the last couple of quarters.
Yeah, it's interesting because I think what you've just described there is, why the industrial real estate sector has been so resilient as a result of this very disruptive pandemic. And you also alluded to, Amazon, and we know Amazon has really been the catalyst here that's effectively revolutionized shopping into the online world. And I would argue that it, to date, has basically been dragging other traditional retailers along. Talk about that, because I think that might speak a little bit more to, other potential growth over time, or whether you think that's really largely played out to date.
Yeah, it's a great question. And look, Amazon's looking for another 250 million feet in the US. Who would have thought that? Because I think most of us, most spectators would look at the US and think that that's a very mature e-commerce market. To use a baseball analogy, the e-commerce is probably in the 7th inning in the US. And here they are still looking for hundreds of millions of square feet of space. If you remember, I find these chats some of my favorite that I do, Dean, because you take a real professional investment view of real estate. So it's always interesting where the questions come from. But from my perspective, when I was at Pure Industrial, I always said that I thought Toronto was going to be the strongest market, and this was 5 or 6 years ago. But what didn't happen was Amazon didn't really invest in this space in Toronto, and it's because Canada is a relatively small market. It wasn't on their radar. It took Amazon to come to Toronto and force all of the retailers in Toronto and now Vancouver and now Montreal to change their supply chain and to change their distribution standards. And we're seeing the effect of that on Toronto. The vacancy is just over 1%. I don't see that changing, at least in the near to medium term. And that leads to our thesis in Europe as well. So one of the things that we emphasized in our strategy that we launched in 2018 at Granite was cold storage, for example. We felt that there was not enough modern cold storage space to meet the growing demand for grocery e-commerce. So we developed a new grocery e-commerce facility in the Netherlands with a company called Ahold Delhaize, which is an international grocer. And this is a brand new model that they're implementing across Europe. All of the trucks that they use are electric, so their carbon footprint is very low. And now they're reaching, masses in the Netherlands, and that part of Europe is very densely populated. It's very affluent or relatively affluent. And we see that that's really a future. We see e-commerce, the potential for e-commerce in mainland Europe, the growth potential is massive. There's no dirt. It's very hilly. Development is a very difficult thing to do in Europe. It's not embraced, obviously, by most municipalities. So we see the factors there all leading to higher occupancy and higher rent growth and e-commerce adoption. And I think that there is that sort of potential that we see in Europe in general, we really see in food. And let's not forget, when these vaccines, whenever they come, they're going to need to be stored somewhere. And there just is not enough cold storage space, modern cold storage space, to meet that growing demand. So this is an area we're really focused on. It's very competitive. At first, we saw the opportunity in cold storage being that there was a pricing difference because of the customization usually associated with these types of facilities. But if you have a modern facility with modern equipment, we really believe in the future and the growth potential of that part of our sector in e-commerce. So, I think that the future is going to continue to be very bright across all of our markets because of this. And we've seen it. And you're right, the pandemic really accelerated this absorption. I can't tell you. I'm sitting in my house right now overlooking the street. I think we averaged 2 deliveries a day. To be honest with you. Now, maybe that abates, but it's certainly not going to abate to where we were before. I think this is truly the new normal. And once people get accustomed to ordering food and other items online, it's just going to continue in my mind.
Yeah, it's interesting. You raised, a number of interesting points there in terms of how Granite is looking to diversify beyond kind of traditional industrial. We know, and there's evidence that one of the things that the pandemic has done is accelerated the adoption of online grocery, and I think that plays to the cold storage. We're an investor in other players like Americold, and
100%.
We see the upside in businesses like that. So it's encouraging to see that you're moving in that direction as well. Now, let's just take it back to this description of kind of where we are in the industrial real estate area. You described that as the seventh inning, and some people might construe that to be, oh, we're near the end. Is the type of growth that we've seen historically sustainable, given that we're not in the third inning, we're in the seventh inning? And, talk about that, maybe in kind of releasing spreads and, the challenges that you might be seeing to bring on more space in specific markets.
Yeah, it's a great question. And I think in each overall market, i.e. the US, Canada, Europe, Western Europe, you have to look at those independently, and I think that we do. So for example, let's look at Toronto. So to me, the story of Toronto is international immigration. So every individual uses or needs an average of 80 square feet of storage space a year. So if you're adding 120,000, 125,000 new Ontarians by virtue of Toronto, new Torontonians every year because of international immigration, that means you need roughly 10 million square feet of absorption. And that's exactly what we've seen in Toronto every year for decades, right? And so because of that immigration, and even in 2008, 2009, 2010, we literally had 100 million square feet or roughly 80 million square feet of vacancy, and then supply stopped. And it is one of the great regulating factors of our industry. There never can really be oversupply. There can be short term, but it's really not. It's not a structural issue because new supply just stops. As soon as there's oversupply, it just stops. And again, on the flip side, as soon as rents get out of hand, supply picks up and it does regulate that growth. It's a very defensive asset class. But what we saw in 2010 to recently in Toronto is the vacancy went from 80 million square feet to 70 to 60. So it was like that 10 to 12 million feet. Now with e-commerce, and really this is about the expectations of the consumer. If you want something delivered same day, there has to be a lot more storage to accommodate that requirement than if you were willing to wait a week or 2 weeks for it. So that 10 million square feet that Toronto was averaging, now it's 15 to 20 million feet. So it adds a 50% or higher amount of demand concentration on those markets. When we look at the US, it's not so simple in my mind. So we try and identify markets where we see growth, where we see population growth, where we see demographic shifts, where we see business growth, and where we see evolving supply chain nodes. And for example, that's why a lot of our assets are in the Midwest. It's that proximity to labor, proximity to cargo airports, to rail, to highway infrastructure, and most importantly, it can get to a large part of the population in the US within a day's drive. So the Louisvilles, the Columbuses, the Cincinnatis, they all have those common features, and that's why those markets have done so well, and that's why we're in those markets. So you have to identify. Once you go to Europe, again, it's different. There are no major industrial markets per se in Europe. There's no LA in Europe. There's no Chicago as a market in Europe. It's just a collection of smaller markets. So for us, it's really about the supply chain corridor. The most critical one goes from Rotterdam to the Mediterranean, and that also crosses the highest concentration of population almost in the world. So it goes through that swath, at least in Europe, I would say. And that's where we feel we're going to have the most success, because that's going to remain the most critical distribution corridor once e-commerce becomes more mainstream in mainland Europe. So we approach it differently, Dean, between markets, but we're looking for those sort of common characteristics in those markets which we think are going to drive our growth.
And when you look at those markets, Kevin, and the ones that you think, do exhibit the best growth prospects, are they becoming increasingly competitive from both an acquisition standpoint and or a development standpoint?
Yes, I will tell you, like I said, there was a very brief downturn in the markets, I would say, early in the second quarter. And then I think by late in the second quarter, we saw investment demand pick up, particularly in the US. In the US, you just have more data points. There's just much more transaction volume every year in the US than anywhere else in the world, including Europe. And so we saw pricing surpass pre-COVID levels late in the second quarter and into the third quarter. And I find it, in some cases, I felt it was a little frothy, but it's hard to argue with that thesis. You're trying to put capital out there. You want it to be in a safe haven, and you want growth. Well, it's hard to argue that and you had the U.S. Treasury at 60 basis points. So if you're buying something which was a 5 cap or a 5 yield going in, and now you're probably willing to pay a 4 because you're still almost 350 basis points over Treasury, and you expect to get growth. So it's hard for us to argue with pricing that we actually saw. Where we saw the most growth was not necessarily in LA, like the gateway cities. Where we saw it really was the Midwest. So any market where you saw 5 yields plus going in moved materially. I would say 50 basis points, in some cases 75 basis points. It's hard to say LA moved from a 4 yield to maybe a 3 3/4 yield, because there is that expected growth still in LA. They've come to expect 4 to 5% rent growth every year. I'm not sure I subscribe to that thesis. We feel we are going to get 3 to 4% rent growth across most of our markets, and going in at a 4.5 to 5 yield makes a lot of sense to us. But that's where we saw that level of growth. In Europe, we are seeing Germany continues to be the main market, the target market for most institutional investors, and we've seen deals in the 3.5 yield range, if you believe it. But we've been interested not only in Germany, but we've done most of our deals in the Netherlands because we feel on a risk reward basis, it is a better market for us right now. I'm not sure a 3.5 yield makes sense to us if you don't see a pathway to substantial growth over the term of the lease in place. So we've been doing more business in the Netherlands, but we've seen pricing come in 40, 50 basis points from maybe what we would have seen 12 months ago. So we've certainly experienced it, and we've had to be very selective in where we feel we should push on pricing.
And I can only assume, Kevin, although we know the cost of debt is extremely low, generational lows, and probably stays that way for some time. We'll talk about that in a second. But in order to be able to do deals at 3.5 to 4.5 cap rates, I'm assuming, as you allude, that you're seeing some real potential for rental growth over time to compensate you for those lower cap rates?
Yes, and I think our challenge, Dean, in these deals in Germany, and you did ask about development. I will touch upon our thoughts on development. I think the biggest challenge we've had with deals that we've seen, opportunities we've seen in Germany, is they've been long-term lease assets with 1% CAGR. And that's what I don't understand. I mean, the going in yield could make sense at a 3.5 if the rent is low versus the market and you really anticipate a lot of growth. What doesn't make sense to me is why you would lock in at a 1% growth for 15 years at a 3.5 yield just because you can finance cheaply. That just doesn't make sense to me. I don't think it's the right move for our unit holders. So that's where we have to be selective. Most of the leases in the Netherlands are CPI indexed. And so we're doing the deals that we're doing are CPI indexed. So CPI, we're not expecting it to be very high. I agree with that. But we do believe that CPI will be higher than 1. And by the way, listening to central banks, there doesn't seem to be as much fear around inflation as maybe there was in the past. So CPI could creep up, and we feel we will get at market rent sooner than 15 years. On the development side, we have roughly 150 million slated for development. Our spend this year, we have developments. We have a small expansion in Toronto. We have a lot going on in the US, and we have development planned in Germany. So we're happy to do that. And I think we want to do more. We've had success in the past with our developments. There is still profit there. There's more profit, frankly, in the US still. And I think one of the things that we need to be mindful of is land values. So we bought 190 acres in Houston last year, and we were planning to go vertical with the first 2 buildings, 650,000 feet this year. But I think, number one, Houston's been hit by COVID like everybody else, but it's also been hit by oil prices and a hit to the energy sector, which has impacted Houston. So we're going to take a wait and see approach. But the point I'm making on development is we bought 190 acres for 33 million US, which, roughly 45 million Canadian. That 190 acres in Toronto would have been over 400 million, roughly 450 million. So much harder for a REIT of our size to carry that cost. And frankly, the profits are better. We can still build to almost a 7 yield in our markets in the US versus a stabilized yield of 4.5% to 5%. So that still makes a lot of sense to us as long as we're underwriting the markets correctly and prudently. And we want to do more in Europe. It's just, to your point I think you made, it's very difficult finding development opportunities in Europe. Most times in Europe, like in the Netherlands, you need a tenant before you can build. So you're not even, in most municipalities in the Netherlands, you're not allowed to build on spec, which really keeps supply in, but it just, if you're going to target land, you have to target land, you have to get your entitlements and get a tenant before you can go vertical. So it's a thoughtful process, but a longer one.
So is it fair to say that, in markets where land is cheaper, you can approach them more from a development standpoint and get development yields that are quite attractive, i.e. 7% plus, whereas in markets like Toronto, where we know land is expensive, that this is really an opportunity to drive releasing spreads over time because, the replacement cost is so much higher than, the in-place rents today?
Yeah, and listen, the last 3 deals we did in the GTA, we feel are way below replacement costs. I think we were under $170 a foot. We really like the land, and we do feel we will get at that land at some point on the redevelopment side. But $170 a foot, I mean, right now, if you're $2.5 million an acre, you're over 100 a foot. You're about 120 a foot just for the land.
Right.
And then development charges are over $40 now in Peel, so north of Toronto. So you're 150 to 160 a foot. You haven't broken ground yet. So I think it's fair to say for new product, you're well north of 200 a foot. And so that becomes a challenge. That means you need a $12, $13 rent economically. And I think that there's a bit of risk in that. And that's why we haven't really done that much in Toronto to date anyways. It's finding that right opportunity. Whereas in the US, like I said, you can buy land at $200,000 an acre, $300,000 an acre, and take a chance. And again, in terms of risk, and I love these conversations on risk, the way everybody evaluates risk is different. And I think that that's a great thing. But to us, and I'll say to my team, what's riskier? Is it having a brand new 40-foot clear development that's vacant, or is it having an older generation building with 5 years left on the lease? What do you think is riskier? And I think everyone should have an opinion on this. I frankly think it's important, particularly in our sector, for renewal to always be responding to what the market's looking for in terms of space requirements. So there's a number of reasons we want development to be part of our program, because we truly think it adds value for our shareholders. And I think it is a bit of a risk hedge as well, because you're renewing your portfolio and the quality of it, and you're hedging somewhat against obsolescence, which is something everyone should be paying attention to in their portfolios.
Yeah, I really appreciate how you've looked at this from a portfolio perspective and really bring in that blend between growing through acquisition and growing through development, especially given the e-commerce sector and how it's growing and how new space and space that is really addressing the needs today is important. So we've covered a lot of ground, Kevan. Now let's just wrap this up. So when I look at Granite, the stock is up, excluding the dividend, the stock is up 15, 16% year to date. We know the REIT sector broadly is down 15 to 20%, so you significantly outperformed. So when an investor asks you, Kevan, is this sustainable for Granite? Is that valuation justified? How would you answer that?
It's a great question. I sometimes I feel silly, answering it because we've had such good fortune. But in my mind, Dean, what I get back to is, we're at a $4 FFO, and looking at our plan, and a lot can go wrong, but I'm just saying, look at our plan. I see a pathway to getting to $4.50 in FFO and over $4 in AFFO. On that basis, if you look at what U.S. industrial REITs are trading at, they can trade at north of 25 times. But even if you say, okay, 20 times FFO at $4.50 of FFO, you're at $90. So I do see a pathway of us continuing to add value in the unit price. We just need to keep our heads down, keep doing the right things, keep driving cash flow, and I think we'll be fine, and I think we'll be able to keep moving that share price up. That being said, I am very happy where we are today, and I think to every board member as well, when we were in the second quarter and we were reporting the rent collection that we had and no bad debts, we felt it really was a time for humility, just being thankful that we have the tenants we have. But I will say this, and I've said this on calls before, I agree with people's view that we're lucky to be in this sector. I agree with people's view that we're lucky to have the tenants that we do, but it's not all by accident.
Yeah.
We were involved with those decisions that put those tenants in our portfolio and leased to those tenants. So very fortunate, but I do think that there's a pathway for continued growth.
That makes sense to me. Any level of success is a combination of some good planning, and we also need a bit of luck. So we'll take that. Thanks, Kevan. It's been great getting caught up. We appreciate your time, and keep on with the good work at Granite. Thank you.
Thank you. Thanks for the time, Dean. Always a pleasure.